Let's talk accounting. Riveting, right? Specifically PSAK 38, it's an Indonesian standard, but don't worry, you don't need to speak Bahasa to understand why this matters. PSAK 38 deals with companies controlled by the same people doing business with each other. Think of it like siblings swapping stuff. Mom might not care if it's a fair trade, but others might. This matters because things can get fishy fast. When the same folks are in charge on both sides, are they really looking out for everyone's best interests, or just their own? PSAK 38 tries to stop companies from pulling a fast one under the guise of restructuring, because sometimes restructuring is just a fancy word for moving money around to avoid taxes or line someone's pockets, and that, my friends, is not cricket. Now, restructuring itself isn't always bad. Companies sometimes need to shake things up, but when companies under common control do it, alarm bells should go off. Imagine this. Megacorp sells its rusty old factory to its subsidiary Minicorp for a king's ransom. Megacorp books a nice profit. Minicorp gets stuck with a lemon, and shareholders in Minicorp are left wondering who let the clowns run the circus. This is where restructuring differences come in. That's the gap between what something is worth on paper and what someone actually pays for it. PSAK 38 says these differences need to be recorded properly. Why? Because they can be a red flag for sneaky business. If that factory sale was legit, fine. But if it was just a way to funnel money out of Minicorp and into the pockets of Megacorp's owners, that's a problem. And that, my friends, is what we call a disguised dividend. Dividends, for those who haven't spent their lives listening to CNBC, are basically companies sharing their profits with shareholders. They're usually taxed, which some people don't like, so they get creative. Instead of paying dividends outright, some companies try to sneak that money out the back door. They might give themselves huge management fees or sell company assets at ridiculously low prices to, you guessed it, themselves. Remember that factory example? Let's say Megacorp's owners also own a cozy little real estate company on the side. Suddenly, Minicorp is paying rent through the nose for their new, very old factory. Surprise, surprise, the real estate company is making a killing. See what happened there? Money that should have been paid as dividends and taxed accordingly just magically ended up in the owner's pockets, all nice and legal-ish. This is why PSAK 38 is so important. It's trying to stop this kind of corporate shell game. It's saying, look, we know what you're up to and we're on to you. The bottom line is this. When it comes to related party transactions, transparency is key. Sunlight, as they say, is the best disinfectant. Companies need to be upfront about their dealings with each other. They need to disclose everything, and they need to do it in plain English that everyone can understand. Because when companies try to hide things, it usually means they're up to no good. And nobody likes a shady business deal. So the next time you see a company restructuring, take a closer look. Are they playing by the rules, or are they trying to pull a fast one? Because in the world of corporate finance, things aren't always what they seem.